Oh, hello everyone. I hope you're all well. It's Susie here from Esoteric Trading Solutions. I hope you're looking after yourself, looking after your parents, looking after your friends, looking after your beautiful animals, your beautiful pussycats, your beautiful dogs, or whatever animal you have, and just generally being kind to people in the world just to make this a better place. I hope everyone's doing okay with this COVID virus. I don't know about you, but I'm getting very tired of being in lockdown, I have to say. I'm just dying to go out and see my family and friends and just go to a restaurant or even go to a bar and have a drink, but I hope you're all okay. Anyway, today I'm looking at two different articles, and one's on the dichotomy between equities and gold, a tale of two alternative inflation universes, and another one is also about the dichotomy between obviously gold and Bitcoin. So this writer from Gold Money, and I've mentioned him before, Alistair McLeod, he's used to have his name here, but he's a fantastic writer and he just knows his stuff so well, and I really respect his material. So I thought I'd show this again. He's talking about equity prices are vastly pricing a different story, different inflation story to gold, and he believes that stocks are pricing a massive future monetary expansion while gold is only pricing what central banks have done so far. So there's something seriously wrong, he's saying, between the equity market and the gold market, and I'd have to agree with him actually. The equities keep going up and up and up on lots of money going into the system, just like we saw in 2009. It's been bullish literally since 2009. Even in 2008 the Dow index got to about 5,800. We're now looking at it over 24,000. It keeps going higher and higher and higher. And yet the economy is just terrible, abysmal. Company returns are going to be affected obviously by this COVID virus. The economic conditions out there are shocking. Unemployment's going to dramatically rise and all those sort of things. So obviously they're calling their own book here when they say that they expect gold to outperform stocks going forward and over the medium term, because obviously Alistair McLeod works for Gold Money Holding, the company. But I really do think his information, his article is really, really interesting. And he talks about a period of extremes in financial markets across the globe. We've seen crude oil future prices went negative, the Fed launched unlimited QE, and the equities had the fastest crash in history, followed by the steepest recovery. The latter part seems at odds with the economic environment we are currently in. We are witnessing one of the most pronounced global economic contraction in history, and I agree with that. To me, it's worse than the 1929-33 depression. He said the US economy contracted 4.8% in the first quarter 2020, and the second quarter will be substantially worse. Unemployment is rising at a speed we've never seen before. In the US, continuous unemployment claims climbed to 18 million in just 14 weeks, nearly 3 times as much as during the entire financial crisis of 2008-2009, the great financial crisis of that period of time. He said, we expect this number to rise over the coming months as we will not just see temporary layoffs from restaurants and coffee shops, but permanent job losses as companies go to business. Now, the US is a service industry country. 70% of what happens in the US, in my understanding, in terms of economic the service industry, in terms of restaurants and any sort of service type thing like, tourism and retail and everything else. So basically this figure, if you look at this chart, unemployment claims has just gone through the roof. Seriously, we go back to 1967. Even in 67 it was down here. In 2007, 2008 we're looking at that, but 2019 we're actually looking at that, and yet the equity market is going higher and higher and higher. Something is just not consistent here. Also, he says the US is, and it's not even the US, and he's absolutely right about this, it's absolutely global right across the board. If we look at purchasing managers indexes, which PMIs, that's what that means. It's been an absolute unprecedented destruction in business activity. Okay, purchasing manager indices, which means anything people are buying for business is just gone. Literally, it's just stopped. Okay. The business activity will not go back to normal even after this global lockdown is lifted, because what else is saying, and I agree with this, is there's been businesses completely go out of business, and I've seen that where I live in Victoria in Australia. If you go down this, walk down the suburbs, there's so many businesses that were there that just don't exist anymore. They've just completely shut shop, and this can be small factories, this can be restaurants, it can be anything to do with retail. They just don't exist anymore, which is really, really sad. As a result, earning expectations have come off substantially. We're also finding our banks here, which are the premier banks, the largest four, ANZ and Westpac, came out with their profitability. Their profit was down 60%, both of them massively down 60%. They reckon it's going to be worse in the next quarter, and they cut their dividends, okay? The thing is, why is the US equity market where it is? It doesn't make sense to me at all, I have to say. 24,000 on the Dow Index doesn't make sense. So companies and analysts are still way too optimistic, and I agree with that when it comes to forward earning estimates. They're saying that they expect a fall of about 20% for the S&P 500 companies, but this has been a consumer shock. Consumers are not spending because most people have lost their jobs, so people are actually worried. They put their mortgages on hold. People are actually worried how long is it going to be before they can get another job, and it's getting worse and worse out there. I know I had a friend of mine who applied for a prison office job, and 2 years ago she could have got that job. Now they were inundated with applications, and you just cannot get any work here in Australia. It's terrible, absolutely shocking. A lot of people used to work in restaurants and everything else, and there's just nothing there. So basically he's saying the index was only down, the SP index was only down 9.8%, but the NASDAQ 100 is up 3% of the time of writing this, which is just absolutely ludicrous. He's saying, look at the forward earning estimates. They're going to be negative, straight down, and yet the index is going up, up, up. Something is seriously wrong. You can't have indices go up when forward earning estimates are actually going down. Basically saying, so what are stocks pricing in? In our view, it is clearly the devaluation of the denominator and which stocks are measured. So what he's saying is, if interest rates are negative, you've got a cash flow on top, it's actually going to give a higher price to stock, right? But that's not the whole story, okay? Just because interest rates are actually going down, if revenue's actually going down and there's no receipts coming in, then clearly the price of stock has to come down. I mean, that's really what it is. So even if the US has poured trillions of dollars into the economy, he's and I agree with this, he's basically saying that stocks are not sustainable at this level, even if interest rates are negative. And I'm saying the same thing. Stocks can't keep going up if revenue's actually negative or coming off a cliff, basically. Now we know that the Fed has increased their balance sheet to literally 7 trillion or more. Even at the time of 2008, it was around 8.5 trillion. Okay, so that's obviously where it's going. But the thing is, equities markets where they currently are in the bigger picture, it just cannot be sustainable. So basically saying that equity markets are pricing in way too much good stuff, and they're not really looking at inflation. And the thing is, gold is basically a hedge against inflation, but it's also a hedge against crazy government policy or federal bank policy or any other government's policy for that matter. So he's saying that stock prices should reflect revenue and cost, not just a low interest rate scenario, and I agree with that totally, or not just an increase in monetary supply scenario like quantitative easing. Investors seem to be buying equities as a protection against future fiat currency valuations rather than because they are convinced the stocks are cheap and companies are fundamentally in good shape. Now, the thing is with this, that doesn't make a lot of sense either, because if they're buying US dollar stocks and they're concerned about US dollar devaluation, the fact is they're long US dollars by buying US stocks. So if US dollar comes off, they're actually going to lose money in terms of US dollar because they're actually holding US dollar stocks. So, and I agree, this just doesn't make a lot of sense here. It doesn't make any sense. He said there seems to be that equities are pricing vastly different inflation expectations than other asset classes. Now, I believe that inflation is higher than what anyone says, and certainly what the statisticians say. It's not 2%. Real inflation's at 10%. If we look at our cost of living in the last 20 years or 10 years, everything we touch has gone through the roof. Everything. I get a gas bill. It's, 3 times as high as what it used to be, even a year ago. I get an electricity bill. It's 4 times as high what it was a year ago. I get more and more bills that are higher and higher. Even my rates are higher. My rates for a quarter are $600 Australian dollars, which is a lot of money, honestly, because prices of properties in in the suburb I live in have just gone through the roof. But it doesn't come within the inflation figures. Doesn't make a lot of sense. Doesn't make a lot of sense. He goes on to say inflation implied tips, Treasury inflation protected security yields, for example, suggests that the market is still pricing in modest inflation over the next 10 years with a break even of 1%. I mean, the reality is inflation is at 10%. There's no doubt in my mind, okay? And with that, equity markets shouldn't be where they are. He's basically saying tips have fallen to 1%. The market is not pricing things properly, and I agree. And yet you've got gold going up. I mean, if inflation was going down, gold would not be going up. Gold's, past 1720 US dollars at the moment, and I believe gold could go parabolic to 3,000 quite easily in the bigger picture. So where does that lead us? I mean, stocks look very expensive. Gold, looks like it can go higher and higher. Literally, money's being ploughed into the system from the Federal Reserve. Interest rates are being kept low by the Federal Reserve. There's going to be a backlash. Interest rates can rise quite quickly, and we are already seeing different types of interest rates rise, okay? There's so many different types of interest rates, and certainly corporate debt is starting to rise in terms of interest rates, okay? So then he's going on to say, the S&P with the gold ratio, even that's changing. The correlations are completely different again. And effectively saying something is not right here in terms of the pricing mechanism of markets, particularly when we talk about equity markets. And I tend to agree with that, because ultimately at the end of the day, the equity market will have to start looking at revenues, particularly revenue that's not coming in because people are not spending. The consumer is not spending because they've lost their job. And if the consumer's lost their job, people are not creating that demand. And that's the biggest thing, okay? So he's saying that the Fed should let the stock market crash. It should have let it do its thing in 2008, 2009. And the fact that it hasn't, this is going to be a bigger problem going forward, because when it does crash, it's going to be even worse, because it's being kept up there at even higher, loftier levels than what it was, pre 2008, 2007. So, it's going to be very, very interesting. He basically says there will be a stock market crash, but the thing is, stocks, yes, it's hard to see them going much further, but they could go up, obviously, on this cheap-ish money being issued by the Fed. But the thing is, we've seen also in repo markets that money is not cheap. The repo rate went up to, literally 15%. So, something is going to give here, and I do believe it will be the stock market. That's pretty much my belief, and I believe that this scenario is quite true, that stocks would come down and gold could go up. Now there's another article I'd like to bring to your attention as well, just in the same vein, and this was produced by 3 Commas and it just came out today, the 6th, and it talks about the next gold rush. Is it to overtake the market? And it talks about the world being quarantined. We know that small and medium businesses are literally demolished. Unemployment rates are reaching new highs, more high than we've ever seen before, even in 2008, 2007. I mean, we're getting into the 1933 unemployment right across the globe. Okay. At the same time, this article talks about the crypto industry has witnessed capital flows and intense growth of interest in the first quarter 2020. Okay, and also, what's happening with gold and the crypto market. So he's basically talking, this person or she's talking about, the financial crisis. People tend to actively search for alternative sources of income in order to ensure survival. And this person talks about the financial crisis that led to a gold rush and was the recession and massive bankruptcies of the 1890s. The US economy was severely affected by the stock market panic of 1893 and 1896. I love to look at history. It's quite fascinating. And what we find with history is things always repeat themselves with history, because people are always the same. In that time, 1893 and 1896, there was widespread unemployment, and it forced a lot of people towards mining gold. And basically people prospered and kept prospecting. And we also saw heaps of people come into Australia at this time, because in Victoria, where I live, we had a massive gold rush around this time as well. So basically people, even though they weren't guaranteed to find gold, they obviously started mining gold. After the 2007-2008, the United States and the significant increased unemployment rate, Americans from all over the country who tried to solve financial problems came to California searching for gold. People bought metal detectors and other modern equipment in bulk. 160 years after gold was first discovered in California, people came back to try their luck again. Wow, that is fascinating. So effectively saying, that's what people do. And now he's talking about also, obviously with the coronavirus, we've seen another spark in gold around the world, and people cannot get their hands on gold bars or coins. Dealers are sold out or closed for the duration. Gold is extremely popular with survivalists and supporters of various conspiracy theories. It is also a hedge against volatile assets, which now seem to be an essential part of any portfolio. This is especially true as the Fed steadily inflates the economy, printing unlimited amounts of money. And isn't that interesting that things never change in terms of human nature? Even 200 years ago, or things were, they were buying gold in times of high unemployment and everything else. The whole world is in quarantine. The economy has stopped for the first time in history. All sectors are under attack. Gross border deliveries, payments suspended, oil's down, unemployment rates have been growing at unprecedented levels. Traditional financial markets and institutions are forced to adjust, and things are going to never be the same again, that's for sure. So despite all this, we've seen gold go up, but we've also seen a massive interest in Bitcoin. This article goes on to say, even with the coronavirus, more and more people are opening up cryptocurrency accounts. The demand for online Bitcoin courses has grown by 300%. Bitcoin holders or net positions have changed growingly, and they're basically staying in Bitcoin positions according to Glassnode. Derivatives trading is up 314% over last year, and we're seeing that with all financial markets. Apparently people are trading equities, more of the retailers are trading equities, they're trading all different markets, and apparently brokers are inundated with people opening up accounts and this sort of thing. We've seen Bernard's trading volumes, and they broke their record, the January 2018 record. The Nasdaq announced an integration of Corda blockchain in its platform. So many things are going on. Bitcoin entered the top 20 trend topics on Weibo. Bloomberg terminals now use the Ethereum blockchain to rate assets. Amazing. Andrews and Horowitz, and this one I really pay attention to because these guys are very well known. They created another fund for blockchain to invest in cryptocurrency. They raised $515 million in the second fund, more than expected, 450. Wyoming has authorised investments in digital assets by an insurer starting from July the 1st, right? So there's so much going on, which is good for cryptocurrency markets. So, basically world indices have updated and they're actually looking at cryptocurrency. So it's actually saying there's been an acute shortage of Bitcoin, and, essentially that, even with higher commissions, people are starting to buy more Bitcoin. Also talking about, the People's Bank of China looking to do, their digital currency with Starbucks and McDonald's, and that's going to be very, very interesting in itself. So again, saying the same sort of gold rush thing, when things are bad, people look for other alternative incomes, and nothing's changed a lot, and I tend to agree with this article as well. So even though this is a downward trend, this thing looks like a descending wedge, which means it can go back up basically. So he's saying that get ready for the bullish setup, bullish scenario, because this is like the next gold rush. Gold's going up, and also what this article is saying is Bitcoin will go up as well, which probably falls quite nicely into the Bitcoin halving coming in next week and everything else. But this is what's happening in markets, with equity markets potentially going to fall in the future. People will look at other alternative assets, whether it be gold and cryptocurrency. Anyway, look, I wanted to bring both these articles to light because I thought they were both really interesting. I hope this just sheds light on some ideas, and I look forward to talking to you again. Please look after yourself. Please look after your parents, your family. Be kind to yourself. Be kind to your beautiful animals, your beautiful pretty cats. And please just be kind to the world, just to make it a better place. Thank you very much, guys, and I'll talk to you very, very soon. Thank you.